The exact age is 35. No, wait, 25. Actually, the real answer, the one your financial advisor is structurally disincentivized to give you, is that there are 3 ages, and whether you are on the right or wrong side of each one determines whether the same S&P 500 index fund builds you a fortune or quietly dismantles everything you spent 30 years assembling. Here's what I mean. 2 people. Same discipline, same fund, same 7% average annual return. Person A starts at age 25, putting in $6,000 a year. Person B does the exact same thing, but starts at 30. When they both retire at 67, person A has almost $1.5 million. Person B has just over $1 million. The gap is $450,000. But here's the part that makes this genuinely insane. Person A only invested $30,000 more in total contributions. $30,000 in extra cash created a $450,000 spread. The rest of that gap is just compounding. Nothing else. Now, the part the title didn't tell you. Person B did everything else right. Low-cost fund, consistent contributions, never panic sold. And when he finally hit retirement, a 5-year sequence of back-to-back market losses hit his portfolio at the exact moment he started withdrawing from it. By age 73, he had less money than he started with at 67. Despite the portfolio looking fine on paper, he ran the identical playbook as person A. The fund was the same. The discipline was the same. The outcome was catastrophic. And the reason had nothing to do with the fund. It had everything to do with the age at which he started unloading. So the real question is not just when you start. The real question is, at what age does the relationship between you and your index fund fundamentally change? Because it does, twice. And the conventional buy the index, hold forever, don't look at it advice only tells you about the first change and pretends the second doesn't exist. Here's what this video is actually about. Most investing content treats index funds like a religion. The sermon is always the same. Start early, hold forever, fees are bad, and you will be fine. That framework is about 90% correct. The 10% that is wrong can destroy 30 years of disciplined behavior in a single bad sequence of returns. I have hundreds of thousands of dollars deployed in these instruments right now. I have spent years surrounded by the accountants and fiscal lawyers who taught me how compounding, tax timing, and withdrawal sequencing actually work in practice, not in a brochure. And what they taught me has 3 parts. I'm calling them the 3 windows: the growth window, the fragile window, and the third age window. The same index fund behaves like a completely different animal in each one. Think of your wealth as a cargo ship. For the first 20 or 25 years of your investing life, you are at sea. Storms happen, markets crash 30%. Your portfolio drops and you watch a number on a screen go down. And it does not matter. You keep sailing. Every storm is actually a sale you are buying shares at a discount while everyone else panics. During the accumulation phase, sequence of returns risk matters less. If markets fall early in your investing career, you continue contributing at lower prices and benefit when markets recover. The cargo is safe in the hold, but there comes a moment when you pull into port and you start unloading that cargo to actually live on it. And that is when the storm becomes a completely different problem. A wave that barely rocked the ship at sea can scatter everything across the dock. The cargo doesn't care about the storm until you start unloading it. That phrase is going to come back several times. Burn it in. In a few minutes, I'm going to show you a specific number that most financial advisors will never calculate in front of you. It involves the fees you are almost certainly paying right now. But first, let me put real numbers on the cost of the first mistake, because it sets up why everything else in this video is actually more dangerous than it looks. There's a concept so foundational to why the growth window works that finance writers tend to oversimplify it into a motivational poster: the rule of 72. You divide 72 by your annual return rate to estimate how long it takes to double your money. At 10%, your money doubles every 7.2 years. At 8%, every 9 years. Apply that to an S&P 500 index fund, which has returned approximately 10.1% annually over the last 30 years. as of February 2026, assuming dividend reinvestment. At that rate, your money doubles roughly every 7 years, which means $1 invested at 25 becomes $2 at 32, $4 at 39, $8 at 46, $16 at 53, $32 at 60. You get where this is going. $1 invested at 35 instead becomes 2 at 42, 4 at 49, 8 at 56, 16 at 63. That is one fewer doubling cycle, and in the final stretch, the dollar amount lost in that missing cycle is the largest. Because it compresses the widest absolute dollar gap, a 25-year-old who invests $200 a month could have a portfolio worth $512,000 at age 65. That same person waiting 10 years and investing $200 a month starting at age 35 ends up with only about $242,000. Same monthly amount, same fund. A 10-year gap costs $270,000. And I want you to notice what those numbers mean in reverse if you're 45 years old right now. That $270,000 gap has already happened. It is not coming back. The growth window only pays out if you're actually in it. Now, here is the reversal everyone misses. You think the problem with starting late is a time deficit, a gap you can fill with higher contributions and more aggressive risk-taking. And partially, that's true. Investors aged 50 and older can contribute an extra $7,500 per year to a 401k above the standard limit, and these are among the highest leverage financial moves available in your 50s. Use them. But the emotional response to starting late, the feeling that you need to catch up by taking on more risk, is where the real damage happens. Because it puts people in volatile individual stocks or leveraged ETFs at exactly the wrong moment in their investing life. The growth window rewards patience and boring, low-cost index exposure. It does not reward aggression, and it does not reward the psychology of someone who feels behind. The actual solution for a late start is not to change the vehicle. It is to understand which of the 3 windows you are in and what that window demands from you specifically. Stay with me for the next part, because this one makes me genuinely, measurably annoyed every time I run the numbers. The S&P Dow Jones Indices SPIVA scorecard is the industry standard for benchmarking active versus passive performance. Over the 20-year period from 2005 through 2024, 94.1% of all domestic active funds underperformed the S&P 1500 Composite Index. Not 80%. Not the most active managers you've vaguely heard about. 94.1%. And that number gets worse the longer you wait. After 15 years, 89.5% of large cap funds underperform their benchmark. After 10 years, 84.3%. The odds of picking a winning active fund over a 15-year period are roughly 1 in 10. 1 in 10. And less than half, 48.5%, of domestic active funds even survive the full 20-year period to be counted. The ones that imploded or were quietly merged away before the final scorecard were conveniently removed from the tally. That is survivorship bias, and it means the data understates the real failure rate. By the way, hit subscribe if you like this content. Otherwise, the YouTube algorithm may never show you my videos again. Now, the fee math, because the funds that fail to beat the index are not failing for free. As of year-end 2024, the average expense ratio of index funds was 0.11%, compared to 0.59% for actively managed funds. That gap, applied to a real portfolio, is not a rounding error. The wealth gap between a 0.1% fund and a 1% fund on a $100,000 investment is roughly $15,800 at year 10. Approximately $59,100 at year 20, and reaches $165,800 by year 30. That is not a linear progression. The cost of the higher fee nearly triples between year 20 and year 30 because the compounding engine has a larger base to erode in the later years. On a starting balance of $200,000, which is roughly the median retirement savings for Americans in their 40s, double those figures. The gap between a 1% actively managed fund and a 0.1% index fund, compounded over 30 years, costs you roughly $330,000 in wealth you never built, not fees you saw in a statement, not money you consciously spent, wealth that existed mathematically and then evaporated. Every annual fee extraction sets off its own compounding chain of lost growth, and the earliest extractions produce the largest losses because they have the most time to compound. Let me put a person on this. There is an engineer, call him Marcus, who has been contributing to his company's 401k for 11 years. Nobody ever told him to check what he was actually invested in. He was in a target date fund with a 0.78% expense ratio. His coworker, same start date, same salary, same contribution rate, was in an S&P 500 index fund at 0.03%. After 11 years, the fee gap between their accounts had already compounded to over $40,000. Marcus was working harder than his coworker, in part to fund his coworker's retirement. He had no idea. Despite decades of underperformance, the active management industry still manages trillions in assets and generated an estimated $224 billion in fees globally in 2024. That number is not a scandal. It is an incentive structure operating exactly as designed. The advisor charges 1% of your assets, not 1% of their outperformance. Their business model doesn't require them to beat the index. It requires you to believe they might. So your financial advisor, who charges 1% of your assets annually to underperform the index 89% of the time over 15 years, would like to schedule a quarterly review. He has new brochures, very glossy. There is a sailboat on the cover. Here is the part that never makes it into a typical retirement calculator. Knowing these numbers and building a system around them are two very different things. I know people who have seen the fee data, nodded along, and then made exactly 0 structural changes to their accounts because nobody showed them the specific order of operations for each of the 3 windows. At what age to shift what, in what account type, and how to sequence withdrawals to avoid collapsing 20 years of correct behavior in the first 3 years of retirement. That is exactly why I built the Exit Code. It is a digital book, 8 chapters of actual research, with 0 filler, built around 50 years of retirement data and distilled into a mathematical framework for naming a real exit date, not a maybe someday one. 2 things I want to flag specifically for what we've been discussing. The 4% trap chapter demolishes the most widely cited retirement rule and replaces it with a dynamic withdrawal method calibrated directly to sequence of returns risk, the mechanism that kills portfolios during the fragile decade. And the lazy portfolio chapter details the specific allocation that has historically outperformed active traders across 30-year windows, which means it addresses the fee drag problem we just broke down at the mechanical level, not the abstract level. You can get it through the link in the description for less than dinner out. Every year you wait is another year of compounding running in the wrong direction on the wrong fee structure. Now, the 3rd window. This is the one I actually built the whole video around. Let me tell you about Dave. Dave is not theoretical. Dave is someone I know through my own network. We have talked a few times over the past couple of years. In early 2026, he called me with a problem. Dave is 54 years old. He has maxed his 401k for most of his career. He holds low-cost index funds. He has approximately $800,000 saved. By every conventional metric, Dave did everything right. He was planning to retire at 58, and then the market dropped roughly 15% in the first quarter of this year, and Dave called me because he was thinking about selling everything. Here's the reversal. You think the problem is not having enough money, but Dave has $800,000. He is not the person you picture when you imagine someone panicking about retirement savings. He is a person who did everything correctly for 25 years, and he is still at risk, not because of the fund, because of the window. Sequence of returns risk is most acute in the fragile decade, the 5 years before and 5 years after retirement begins. During this window, the portfolio is typically at its peak size. A portfolio that suffers large losses in the early years of retirement faces a fundamentally different challenge than one that suffers the same losses later. This risk is most relevant during the years immediately before retirement, when the portfolio is at its largest and most vulnerable to a large percentage loss, and in the early years of retirement, when withdrawals begin and losses cannot be recovered by continued contributions. Sequence of return risk focuses on the timing of market drops and how early losses in retirement can reshape your entire income picture. You can average the same annualized returns as another retiree and still end up with very different results simply because your bad years arrived at the wrong time. Put numbers on it. 2 investors start with $1 million portfolios, take initial withdrawals of $50,000 with 2% inflation adjustments each year, but then experience a 15% drop in portfolio value. The investor who faces such a decline early in retirement runs out of money far sooner than an investor who does so later. Same starting amount, same withdrawal amount, same average return, different arrival time for the bad sequence. One survives, one doesn't. The 2000 retiree faced what may be the modern era's harshest sequence. The dot-com crash of 2000 through 2002, a 49% drawdown in the S&P, followed almost immediately by the 2008 financial crisis, a 57% drawdown. 2 devastating bear markets within 9 years of retirement created a lost decade, in which a 4% inflation-adjusted withdrawal strategy left the retiree with roughly 60% less wealth by 2010 than the same. Strategy delivered to the 1990 retiree. The 1990 retiree did not do anything smarter. They retired 10 years earlier and got lucky on sequence. The cargo doesn't care about the storm until you start unloading it. Researchers, including Wade Pfau, have written about what they call the retirement risk zone, the 10 years surrounding someone's retirement date before and after. If you experience a market downturn at that point, that can really disrupt your retirement plan. If you assume a 7% rate of return, which means wealth doubles every 10 years, when you're 10 years before retirement, you're only halfway to your retirement goal, and you're very vulnerable to what happens in those specific 10 years leading up to the date. Dave, for the record, did not sell. We talked through his situation, and the conversation made clear something important. He had a number. He did not have a framework for the window he was now inside. That is an entirely different problem than not having enough money, and it is the problem that almost no financial content ever directly addresses. This is where the conventional buy and hold forever advice breaks down at the structural level. That advice was written for the growth window. It was never designed for the fragile window. And almost every piece of index fund content I have ever read either ignores this entirely or mentions it briefly in a footnote. It is not a footnote. It is the entire second act of your financial life. Now, here is the part that surprises almost everyone who hears it for the first time. The solution is not to move out of equities as you approach retirement. That is the intuitive answer. It is partially wrong. Some research suggests starting retirement with a slightly lower equity allocation and gradually increasing it over time. This approach reduces exposure to early volatility and relies more on growth later, after the sequence risk window has passed. Someone might begin with 40% equities at age 65 and increase towards 60% by age 75. The right compromise for most retirees is 50 to 60% equities at the start of retirement, with a glide path either holding constant or slowly rising back toward equities. Vanguard's default target retirement glide paths land at approximately 50% equity by age 65, specifically because of this dynamic. Both Pfau and Kitces find that the historical sweet spot is approximately 50% equities at retirement, enough to grow with inflation, but not so much that a single bear market in the red zone is catastrophic. Going all bond is sometimes called the safety theater mistake. It feels safe in the short term, while quietly increasing the probability of running out of money in old age. Which brings us directly to the third age window, and the most devastating historical case study in American retirement data. The 1966 retiree is the worst case scenario in 20th century US retirement data. Someone who retired in January 1966 with a $1 million portfolio and a 4% inflation-adjusted withdrawal rule entered an environment of rising inflation, rising interest rates, and a stagnant nominal stock market that lasted until 1982. The S&P 500 closed lower in real terms in 1982 than it did in 1966. Combined with the 12% inflation peaks of the late 1970s, a rigid 4% withdrawal rule from a 60-40 portfolio would have run out of money before age 90, even though the nominal long-term returns over 30 years were positive. Let that sink in. The nominal 30-year return was positive. The math worked in aggregate. The portfolio went to zero anyway. Because the sequence of losses at the start of the withdrawal phase, combined with inflation destroying the bond side of the portfolio simultaneously, created a compounding drain that no subsequent market recovery could repair. You were unloading cargo into a Category 4 hurricane. By the time the storm passed, the dock was gone. The 1973 through 74 cohort survival rate was the data point that originally established the 4.15% historical safe withdrawal rate in William Bengen's 1994 research. It was the worst historical 30-year window observable at the time. Every retirement planning worksheet since then rounds that number to 4% and treats it as physics. The problem is that Bengen's dataset ended before researchers could observe the full trajectory of the 2000 cohort, which, as we've established, faced 2 catastrophic crashes in the first 9 years of retirement. The 4% rule is not wrong, but treating it as absolute, regardless of sequence, regardless of which window you're in, is the difference between surviving retirement and outliving your money. The active fund management industry, for its part, generated an estimated $224 billion in fees last year while its clients were navigating all of this. I find that more hilarious than enraging at this point, which is probably a sign I've been reading SEC filings too long. Now let me take the 3 windows framework and put a real person inside them. Mark, 47 years old, earns $90,000 a year, has $200,000 currently saved in a 401k, wants to retire at 63. That gives him 16 years. He is currently in a target date fund with an expense ratio of 0.7%. He contributes $12,000 a year. Mark is in the growth window. That is the good news. He still has 16 years of compounding ahead of him, and 16 years is meaningful. Scenario 1, Mark does nothing different. At roughly 6.3% net return, 7% gross minus 0.7 in fees, his $200,000 compounds to approximately $530,000 after 16 years. His $12,000 in annual contributions add roughly $315,000 more. He retires with about $845,000. Scenario 2, Mark takes 20 minutes to check whether his 401k offers a low-cost S&P 500 index fund. Today, investors can access broad market index funds with expense ratios in the single digits of basis points. Even zero in some cases, the Fidelity Zero Total Market Index being one example. Let's say he finds one at 0.03%. His effective return becomes essentially the full gross return. At 7% over 16 years, his $200,000 grows to approximately $590,000. His same $12,000 in annual contributions now compounds to roughly $335,000. He retires with about $925,000. The fee switch alone from 0.7 to 0.03 is worth roughly $80,000 over 16 years, not from a market bet, from a 20-minute decision inside the same account. Now, Mark bumps his contribution rate by 5% of salary. That is $4,500 additional dollars per year. At 7% over 16 years, that extra $4,500 annually adds approximately $125,000 to his retirement balance. Combined with the fee switch, Mark's total improvement over the do-nothing scenario is roughly $205,000, and his retirement balance approaches $1.05 million. But here's what both scenarios miss. When Mark is 58, roughly 8 years from now, his portfolio will likely be somewhere between $600,000 and $700,000. That is when he enters the fragile window. That is when the cargo starts getting close to port. And if the S&P drops 40% in 2033, which historically happens, Mark needs to not be in a position where he is forced to sell shares at the bottom to cover his mortgage. That means starting around age 56, he should begin building a buffer of roughly 2 to 3 years of living expenses outside the market. Not his whole portfolio, not 50% bonds, 2 to 3 years of cash or short-term treasuries. The rest of the portfolio stays in equities because Mark is going to live 30 more years and he needs that growth. The buffer is what protects the withdrawal phase from the fragile decade. Mark's real problem at 47 is not which fund he picked. It is that nobody ever sat him down and showed him all 3 of the windows he is going to pass through and the specific rule changes required at each one. The data that sits quietly underneath all of this is not reassuring at the population level. Over half of American households, 54%, report having no dedicated retirement savings, according to the Federal Reserve's Survey of Consumer Finances. Of the 54.3% of US households that do have anything in retirement accounts, only about 9.3% have $500,000 or more. The median American in their 50s, the demographic arguably closest to needing this framework, has an average retirement savings balance of just over $1 million. But the median is $438,866. The average is skewed by the very wealthy. The median person has $438,000, and they are about to enter the fragile window with the same strategy they use in the growth window, which is about as safe as using the same technique for loading the cargo as for unloading it in a storm. 3 things you can do this week. Not abstract things, specific and non-generic. 1. Go into your 401k right now and find the expense ratio of the fund you are actually holding. Not the fund you think you're holding, the actual one. The asset-weighted average expense ratio for equity mutual funds fell to 0.4% in 2024, but the unweighted average remains 1.1%, meaning most investor dollars have migrated to cheaper funds while expensive funds persist. If your expense ratio is above 0.2%, check whether your plan offers a cheaper S&P 500 or total market index option. This decision compounds for 30 years. The math, as we have now established, is not forgiving. 2. Figure out which window you are in. More than 10 years from retirement, you are in the growth window. Historically, the S&P 500 has recovered from every major downturn, including the 2008 financial crisis, which took roughly 4 years to recover, and the 2020 pandemic crash, which recovered in about 6 months. At age 25, even a 4-year recovery leaves 36 years of compounding ahead. Stay in the market. Ignore the noise. If you are within 10 years of your planned retirement date, you are entering or already inside the fragile window. Start thinking concretely about building 2 to 3 years of living expenses in stable assets outside your equity portfolio. That is your insurance against a bad sequence, not your entire strategy. 3. Separate your withdrawal math from your accumulation math. The 4% rule is a starting point, not a law. Rigid withdrawal plans can cause unnecessary damage. Instead of taking a fixed percentage regardless of circumstances, a flexible approach might reduce withdrawals slightly after a negative year and increase them after positive years. This one behavioral adjustment, reducing spending by 10 to 15% during a down sequence, can extend portfolio life by years in the worst historical scenarios. The person who went broke in 1966 did not make bad investment choices. They applied an accumulation phase rigidity to a withdrawal phase problem. The cargo doesn't care about the storm until you start unloading it. Dave is going to be fine. He did not sell in the correction. He now has a buffer plan in place for the 4 years before he stops working. Marcus switched his fund and found $87,000 in lost compounding in under a year of difference. Mark has a framework for all 3 phases, not just the first one. Lazy investing built more fortune than crypto memes. And if that sentence makes you feel calm, check your expense ratio first, because calm is one of the ways this system gets you to keep paying for the boat on the brochure.